Welcome, everybody, to another episode of the Good Deeds No Investing podcast. I am your co host, Chris Seveney, along with Mr. Jamie Bateman. Jamie, how are you today?
Doing well. How are you, Chris?
I'm good. We finally got our new little setup now working, finally, after several failed attempts. I figured out what was going on for those watching this on video. Got a little new backdrop screen and so forth. We actually look somewhat professional, except my hair, of course, but
Somewhat.
that's that, yeah.
And the fact that I'm in a different room in the house.
Yeah.
But yeah, it's pretty neat. We finally got it working.
Yeah. So it's those watching the video, make sure to check it out on Jamie's YouTube channel, Labrador Lending, or mine, Seveney Investments. So today we are going to be talking about what are we talking about today, Jamie?
We are talking about the top things to look for when investing in a note fund.
Yeah, we'll call
So
it.
it is a little more geared toward passive investors for this one.
Yep, we'll say top five, but
Top five.
we may throw in some bonus content as well, like we always like to do. Uh, Prior to that, though, Jamie, why don't you touch base with what you had going on this week?
Actually, it was a pretty good week. I'm not going to complain as much as I normally do. um, one thing I was going to touch on is we're selling an asset that looks to be a pretty good win for us. So I'm excited about that. We had purchased a loan about 10 months ago, modified it, and the borrower's been on ACH ever since and was paying before the mod as well. And we're selling that one. So, and also the person who's buying it is pretty new to notes, and I've kind of been helping him through the process a little bit, and I've personally bought notes similar to what he's buying, and it's been great for for an IRA or any kind of tax advantaged account. So I'm excited about it. It's going to be a big win all around, and it's been good for the borrower, good for us, and good for the note buyer. So I'm excited.
Cool. So I've I got my new standing desk, so I'm actually standing up now. As you know, yesterday I was a little more
Nice.
fired up and excited on one of our calls
Yeah, you were.
yesterday.
Yes. I
To
had
say
to
the
ask you
least.
how many cups of coffee you'd had.
Yes, I was having a conversation last night with somebody, and I said, "Yeah, I think Jamie got a little spooked by. I had like over 8 hours worth of sleep the night before and stuff. So yeah, I was rip roaring ready to go. No,
No,
actually,
I like it.
this week, late last week, we closed on four more assets. I had some loans transferred to new servicing this week. Let's see what else. I got a few QWRs need to respond from qualified written responses where a borrower may question or contest a debt. So you need to get your servicer and attorney coordinated to make sure those get responded accordingly. One of
Well, maybe
them's
you shouldn't self-service.
I do not self-service.
That
Actually,
was a joke.
yes, I know. Someone told us we should not self-service. But I do actually, I self-service a post-settlement judgment that I do self-service because, basically the person just pays every month. So it's not, have to comply with any of the CFPB stuff or anything along those lines. But that is something I do. Did get my calculator wrapped up for my membership site. So that is now operational on Mac and Windows. And I know my first trial, there was a few hiccups. So I went back to the developer on that who created the software to license it. And I basically was like, okay, I'm just paying you, get this thing working. I should
Nice.
know by now, just, hire somebody to do many different things. Uh,
Seriously, that's what you do, right? I mean, you're not afraid to outsource.
No,
Um,
I'm not afraid to outsource anything, any way, shape, or form. So actually had one other thing I'll mention. I had two good calls this week with two attorney firms in different states in the Midwest and the Southeast and stuff, and kind of in the kind of northern Midwest as well. That just learning about their services, trying to expand the portfolio of attorneys everybody has access to and uses. So that was another. It was a really good call yesterday with a firm that I thought was only licensed in one or two states. They actually practice in seven. So I'll probably toss a loan over to them to kind of see how they do.
Test the waters a little bit.
Yep. Yeah. And, people who know me know I'm pretty much a straight shooter. I told them that. Oh, my cat's loud this morning. Um, in
I
basically,
was the one worried about background noise, but I guess it should have
so
been you.
no, so I've been working in my basement, and my sister-in-law is actually moving into her new house this weekend. She bought a house a few months ago and has been living down here. And our cat basically is fascinated with her because the cat's like 18, 19 years old. So
Oh, wow.
yeah, so my wife brought the cat from Uzbekistan when she came over. So
Oh, wow.
they've known the cat for a long time. So the cat, when she's here, comes to see like, "Where are you?" and starts calling her. So little inside tidbit that
Cat's more
nobody needs to
important than
know.
you are.
Oh my God, yes. Oh, if it was I mean, it's not even like a question of who's more important. So Jamie, I digress as usual. So why don't we roll into some of the top 5 things to look for as part of a note fund?
Sure.
I'll let you go
Number
first.
one, a competent and experienced manager.
Uh,
I say manager, could be multiple managers, whoever's actually operating the fund.
Yeah. So, few things that pop in my head on that, yeah, is competent and experienced. Now, competent, of course, is I think self-explanatory. Experienced for me is somebody who's been in the business and understands a portfolio. They may not have ran a fund before, and that's not to me a big negative. It's something that they got to adjust and grow to, but you do a little more due diligence on them to understand how they anticipate on managing a portfolio, because managing 1 or 3 notes versus trying to manage 20 to 50 and that mix of performing and non-performing is a little more challenging, but it's something that can be overcome. I would rather rely on somebody who has done 50 notes or 100 notes and are on their first fund than somebody that starts a fund after 5 notes and may have done 2 of them and is on their third one. I'd rather have that experience with the asset class than with the fund management, because that is more somewhat of a business practice component to it, which again, there's some risk involved. But I think at the end of the day, if we'll talk about some of the other characteristics to look for. I think it's something that's important, but not as important as actual experience.
Yeah, that's a good point. I mean, I think I'll probably mention this two or three more times during this episode, but to me, that whether you're investing in a note fund or multifamily syndication, whatever the asset class is, whatever passive, I guess, investment you're making, to me, the operator who's actually managing the day to day, of the fund is the most critical piece. So you can do all the research you want on investing in notes, or all the research you want on market conditions, or whatever else is going on, the particular deal you're investing in, the particular notes you're buying. But at the end of the day, there does have to be a level of trust with that manager. And so to me, that's the key piece.
Yeah.
Absolutely.
Oh, trust is going to go a long way, because people ask like, what's stopping me from losing all my money? What's stopping you from running away
Hmm.
with my money? And besides
Yeah.
the laws, I mean, nothing. I mean,
Yeah.
it's just
Yeah.
like
No, it reminds me of, I've sold a partial, I've sold many partials, but
Mhm.
one partial that I sold was, a guy asked me, what's stopping you from reselling a partial on this same note, this same stream of payments? And at the end of the day, nothing. It's I could do it. It's just there is a level of risk, I guess, and trust that's involved in the manager. So
Yeah. You, you can't
that's
take all the risk away.
no,
So,
no.
like any investment. I mean, when you invest, I invested in WorldCom back in the day. I thought that was a great company to invest in. Guess what? Didn't work out, and what I get for it, lost everything. But you're
Yeah,
right. There's nothing you can do to stop somebody if they're going to basically do something illegal. You know, then that's why
right.
you got to really truly vet them and do extensive research on them. My self plug for this component is, I do have on my website a downloadable little ebook on questions to ask and due diligence on sponsors, investors, and people in real estate.
Yeah. So let me ask you before we move on to the next one. When you
Yeah.
did your first fund,
Mm-hmm.
you hadn't done a fund before, right?
Yeah.
So, um, what kind of research did people do on you, or what do you think you brought to the table at that point to help you get over the hump. Now you can say you've run multiple funds, but at that
Yep.
point, what were things looking like?
Yeah, it was so it was a 506B. So it's people I had pre-existing relationships with.
Got it.
So it was people who had done JVs with me, who knew who I was, and were comfortable knowing that I was looking out for their best interest. And that's really
Mm-hmm.
what it comes down to. Some people who invested with, I've had a few deals go bad, and at the end of the day,
Mm-hmm.
I made them whole. And
Mm-hmm.
basically they're like, hey, look, that's great, we and stuff, and they were happy with that.
Mm-hmm.
Even though they wish they would have probably made more money, but then they continue to reinvest, and it's interesting because those that have done that have reaped the benefits as well. So because that first fund
Yeah.
has done very well.
Yeah. And I think the fact that you had done a bunch of joint ventures and
Mm-hmm.
partials and things like that speaks to the fact that you could probably make the leap and
Mm-hmm.
run a fund. So
Yeah. I'll be honest
makes
with you.
makes sense.
The biggest challenge I had with early on some of the funds I did, getting the
Mm-hmm.
right balance of the waterfall, which we'll discuss later on, and making sure that I'm not taking too much and I'm not giving away too much. So that's really one of the challenges in understanding the cash flows, which we'll talk about again later on.
Mm-hmm. Okay. So second key thing to look for if you're looking to invest in a note fund,
Mm-hmm.
transparency.
Yeah,
You want to speak to that?
yeah, I'll start. And I don't know many funds that are transparent. Honestly, a lot of them in the note space. Let me start by
Mm-hmm.
that. Multifamily
Mm-hmm.
deals, you know what you're buying. I'm buying this
Mm-hmm.
100-unit apartment building. A lot of that information's available. The note space
Yeah.
is actually, it's very weird because people they're investing in a black box. It's like, where's this going?
Mm-hmm.
And that's one of the things that I think I've done a little. I like to kind of differentiate myself and from funds, and we've got Integrity Mortgage Note Fund that we recently
Mm-hmm.
launched, and it's about transparency, saying, guys, girls, guys, everyone who invests in this thing, you can see every single note that we're investing in. You know
Mm-hmm.
what it is. A lot of the other funds, you have no idea. It's a black box. So
Yeah.
I find that interesting that I'm surprised a little bit why more funds don't do that,
Mm-hmm.
honestly. But
Yeah.
I don't know, but I think it's something that's important just to understand if you're comfortable or not with it.
Right. I've invested in certain funds, both in the note space and other asset classes, and they can vary wildly on not only even if the operator intends to be transparent about things, even if they're not specifically hiding something, how often they communicate or how they communicate is critical as well, and it helps that transparency factor. So I've had investments where they've gone well, but I didn't have as much communication as I would have liked, or the portal was a different portal, and I couldn't quite access what the investment actually was
Mm-hmm.
how it was performing at the time. So I think just having that access is critical, helps. And even I'd rather take, I don't know about you, I'd rather take a slightly lower return if I have an idea what's going on with my money for 3 years.
Mm-hmm.
It gets to the whole return of capital versus return on capital. But I think transparency and communication go
Yeah.
hand in hand.
Yeah, I was going to touch base briefly on that communication standpoint on letting
Mm-hmm.
investors know, even though you may have a portal, just still sending something out, whether it's biweekly, monthly,
Mm-hmm.
quarterly. At minimum, I would think there'd be some type of quarterly reporting that you
Yeah.
send. Basically, when you pay, if you're paying a distribution quarterly, here's distribution. Here's kind of what's going on. Here's kind of
Right.
assets acquired, assets that we've sold off, something
Yeah.
along
I've,
those
I've
lines.
have actually have a current investment that it's doing well, and it's not in the note space, but I'll get a quarterly deposit, and I have no idea what it is, and it's not
Mhm.
because I haven't tried. And they do eventually respond, but
Mhm.
is this 90% principal coming back to me?
Mhm.
What is this? And so I think, and that's one of the things I've learned with, especially with my joint ventures, is kind of trying to time the communication of the reporting with the actual payouts and deposits,
Mhm.
because that can be a little confusing for an investor if you're getting money and you don't know where it's coming from. So
Yep. And my recommendation is, people are looking at doing a fund, uh, unless it's a performing note fund, that I
Mm-hmm.
would not pay distributions on a monthly basis. Just
Mm-hmm.
because by the
Yeah.
time you get your books done and ready and everything, there's a lot to do that on a
Right.
performing note fund and with a preferred return. That's a lot easier to review versus the
Mm-hmm.
non-performing because you've got a lot of moving pieces and parts. So just
Sure. Makes
uh,
sense.
yep.
Okay.
So number three, uh, make sure the fund based on economic conditions is supportable over the term of that fund, and that's one of the things that you got to
Mm-hmm.
look for is what's the length of the fund. How long? What's the lockup period of a term? How long is your money going to be
Mm-hmm.
tied up? That's an important
Mm-hmm.
thing to understand because right now, for example, the economy's pretty hot on housing, but if you're tied up in something for 5 years, you think it's going to be worth more in 5 years? You think it's going to be worth less? So that's something
Mm-hmm.
to consider. What are your thoughts?
Yeah, I mean, I think, like we said, the operator is, in my mind, the most important thing. But really, right under that is the asset class and what you're investing in. So, to me, the market conditions speaks to assessing the market conditions speaks to comparing asset classes. That's for me. So, you know, nobody has a crystal ball, but I would assume, and by the way, none of this is investment advice or legal advice, um, but I'm taking the presumption that we are going to see an influx of non-performing loans in the next 12 to 24 months. Who knows if that definitely will be the case, and we'll see. But to me, housing, like you said, is really really hot right now. I think the stock market's pretty pretty frothy right now. So um, I think the economic conditions point to the fact that there will be, a lot of it depends on government intervention, but there will likely be an influx of non-performing loans, and we've seen such a rise in the housing market that I think that equity protection will, for the most part, still be there. So you've got to look at kind of the macroeconomic factors as to should I be investing in a multifamily syndication or multifamily fund versus a note fund, versus
Storage
what do you think that
facilities are, you know,
absolutely mobile home parks, and you know we've talked before, every asset class has pros and cons, but that's not a set in stone kind of thing. You've got to look at what's going on in the larger, the larger economic world, if you will.
yeah, interesting. And I'm going to digress. When I was taking one of my, it was global investments class at Georgetown, one of the things that was heavily focused on was logistics. And it was interesting because I never even thought about logistics, but it's literally, it's, shipping locations and central points for, set up for a lot of these, the whole shipping industry and logistics where, Baltimore is a major hub, certain areas of South
Mm-hmm.
America, and just where is where's stuff coming from? Where's it going? And what's the flow? I mean, everyone's seen what's happened with the Suez Canal,
Mm-hmm.
recently and
Yeah.
so forth. But and a lot of these major players in that business are buying up buildings and space in certain strategic areas because as products continue to advance and technology advances, that's going to be another major driver of investments, especially in some of the third world countries right now that are starting to develop.
Mm-hmm.
It's just when you look at the types of investments you can invest in, it's,
Mm.
that was one I never even thought of. And I'm like,
Just logistics in and of itself as an asset class
yeah,
or
just whole,
okay,
logistics and shipping, between
interesting.
all these shipping companies because of, Amazon and everything else, that's come aboard over the last 5 years. And, we had to do a case study on it. It was really, really interesting because again, it was like notes. 5 years ago, I didn't know notes was an asset class. 1 year
Mm-hmm.
ago, I didn't know logistics was, and shipping was a type of asset class. So,
Yeah, it's yeah, you got to be open to learning and asking questions, and
yeah. So,
um, always expanding. So,
okay. So let's roll number four, which is, the waterfall slash pay structure And is there preferred return? Is there upside potential? What does that look like? And
Yeah.
there's many different characteristics, and I'll let you start.
Yeah. I mean, I think, if you're an investor, it depends on what you're looking for, right? So if you have, $10 million and you're really looking for just a protection, maybe you're not looking for that upside. But I think a lot of funds nowadays are probably paying what, maybe 7-8% preferred return, and with no upside in the note space anyway.
Yep.
So to me, I'd rather have a little bit of potential for that upside, and so I do want the preferred return, which kind of is a little bit safer, if you will. They talk about the capital stack, and like if you're investing in different asset classes, you can invest in equity, preferred equity, debt. Preferred equity is kind of a blend between the two. So in a sense, I would kind of equate our fund, the waterfall, almost like preferred equity, in the sense of you're getting a preferred return, a targeted preferred return, but there's also the chance for some upside on the the sale of particular assets. So to me, I'd prefer to have a little bit of a blend. What are your thoughts?
Yeah, so I'll get several comments on this one. So yeah, I've tested basically several different components where I'd done one where it was a straight 50-50 split, and say, hey, we're just going to split like a JV. And what I found is non-accredited investors didn't mind that. The accredited investors want a preferred return. So I did kind of A/B test this. And so let's start with, okay, you start with a preferred return. Like you said, I've seen some that so one of the things I'll mention is when we say preferred return, these are projected, these aren't, basically it's like, hey, I could give you a 50% preferred return, but guess what? You're never going to get there.
Right. You can make all the promises in the world.
Yeah,
right.
I can make, whatever. It doesn't matter what goes on that piece of paper essentially for preferred return, in the sense of, yeah, that's what you could get, but are you going to get it? So that goes back to the first one of the manager's experience. But like I said, I've seen some that go like up to 10% from that perspective. So I think having that upside is, preferred because it gives both a vested interest. I think it splits kind of that vested interest where both parties get to share some of it. If it's only on one side, is the manager, if it's not doing as well, going to take more risk to try and get a little more money from themselves because they might not be making anything. And when I see when I see 10%, or up to, so I've done one that had initial 10% preferred return. I can tell you as a manager, you're not making anything until you start selling those assets or they start closing, because you've got some performing in there, and they'll provide some type of return, but you also have, you have your management expenses, and you get you'll get your management fee, but that's that's not a lot.
Right.
So
it's almost like buying buying performing notes at 11% and then selling partials at 10%.
Yeah,
you're not really you're going to make the money on the back end, but you're not making anything during the time of that partial.
So the other thing that was interesting in what we did that I thought was very unique, and I like it, and honestly, was we moved our management fee after the preferred return. So truly shows like investors, hey, you're the first one, after expenses in the fund, you're first, money goes first out the door to you. So I think that's critical. But one thing I wanted to just touch upon about management fee, and I find this interesting because, and this is my note and bolt for everybody, look at what it's based off of. And the reason I say that is you're like, well, it's a management fee. I've seen management fees based off of unpaid balance. I've seen them based off of the lower of the unpaid balance or fair market value. I've seen them based off of the assets under management. And here, let me give you an example. Let's say management fee is 1%, which is low. Honestly, they're typically in note space, 2 to 3%. Some people may not charge one, but usually you'll see 2 to 3%. So let's say you raise $1 million, keep things simple, and you're at 3%, excuse me, based on assets under management. That's $1 million raised, 3%, quick 30 grand. Okay. With that $1 million, if you had $1 million, Jamie, you'll keep some of it for, expenses, but what's the UPB going to be on $1 million of assets that you're buying?
Yeah, I mean, I guess if you're doing, say, 75% of them, or say 2/3 of them are non-performing.
Yeah.
I mean, you know,
Just rough numbers.
yeah, $1.8 million.
Well, let's keep it nice and simple. 2 million. So, yeah, I mean, but here's the thing: you might buy a loan that has a $400,000 UPB, but the house is only worth 50,000, but they're still basing off of UPB. Right. So let's just say it's double. All of a sudden, that 3% management fee isn't 30 grand; it's 60 grand.
But right.
When you look at how your returns are calculated, if the fund was making 10% on the million, it made 100, and then 60 goes to management fee. There's only 6% left. They're basically they're doubling their management fee because your returns are based off of the amount of money you have to invest. But if your management fee is based off of something else, it's double.
Yeah, no, that's a good point. You can't just say, what's the management fee? 3%. Yeah. 2%.
3% what? So
Right. Good point. Yeah.
So it's one of those crazy little things I picked up when I was reading. The other thing, kind of just touch upon is, and kind of this is, I'll say, kind of rolls into number, I'll say 5, I guess, is, the legalities of the risk involved.
Okay. What do you mean? What do you mean by that?
So what is at stake? Is it only your investment? Can they go after you personally? How is the investor protected? There's some that I've seen that have clawback language that say the sponsor, if giving you profits and there was ever a problem at the end, they could claw back some of those profits. Is there leverage? Can they leverage, which then would be a bank loan, and what are the personal guarantees involved with that? So really understanding, what is, most people, I think, would want to have it structured where what I have invested is the risk involved. Make sure there's nothing else.
Right. You can't lose as an investor, as the passive investor. You can't lose more than what you put in, is what you're saying, right?
Yes. So that would be something that you definitely want to look for. Honestly, this is something that I think surprises me a little bit. That with a lot of investors that I work with, I don't think a lot of them have an attorney review the PPM.
Interesting.
Yeah. So, I mean, I have my attorney review everything and anything. So I had a digression moment. I need a little bell here for like a digression moment, or you need to have one. I had a borrower just send me a settlement agreement yesterday to basically resolve an issue. And one of my attorneys sends it over to me and says, "Hey, you okay with this?" And I look at it and I'm like, reading this, I'm like, I can't believe my attorney hasn't like commented, like, why would you sign this? It's basically a settlement agreement that the guy has to pay me X amount of dollars to resolve a foreclosure case, to basically buy out the loan. But if he doesn't make the payment, then nothing happens. So it's like, so what good's this agreement? It's like, great, I'm going to put on paper that here's what we agreed to. We're agreeing to a short payoff, but if I don't pay you, nothing happens.
So it's essentially like an unsecured loan. I mean, it's
yeah. I mean, so basically,
there's no teeth to it.
Yeah, I took the I took the lion, Brian Gallagher, and he went after it, shredded it like a lion catching a gazelle. And, basically we put language in there that says, look, if you don't make the payment, basically you're in default and you're signing over your rights to the property. Basically, it's almost like it's like a deed in lieu written into the agreement if he doesn't pay me.
Yeah. So now
it's actually a land contract. So it'll be a cancellation of land contract.
Mm-hmm. Gotcha. Yeah. I can say, and you and I are working on some other things as well, and working with you, you do definitely have your attorney review a lot. So that which is a good thing, to be thorough and protected and
Mhm.
detail oriented, and and Brian's not afraid to
No.
make comments, and he knows what
Mhm.
what changes to particular documents are likely
Mhm.
to get accepted, and he's also frankly
Mhm.
not afraid of a fight if it's warranted.
No, but I mean, it's fairness of certain things. Like,
Yeah.
the indemnity agreements in most of these contracts that people sign are, you got to indemnify whoever you're paying for everything, but they don't have to indemnify you for anything. Perfect example, I was reviewing an agreement with a company that does document recording,
Hmm.
and similar. I have to indemnify them for everything, but they uh, basically don't. I mean, it's very limited. But then, if there's
Hmm.
ever an issue, they're like, "Oh yeah, we'd only be responsible for like what you paid us the last 2 months, or something along those lines." So I go to Brian. I said, "Well, what happens if I'm in Florida, or just a
Hmm.
note that's in a state that doesn't accept lost note affidavits or lost notes, and they
Hmm.
lose the note?" He's like, "You get 2 months of whatever you paid them the last 2 months." I'm like, "Great. If I paid them
Wow.
$50 to do nothing the last 2 months and they lose a
Right.
$100,000 note," and I'm like, "They'd
That's
have insurance." He's like, "Yeah, they would." And I'm like, "But I don't get any of that." He's like, "No." I'm like, "That's
Yeah. The
pretty,
insurance is for them, not for
yeah."
you.
I'm like, "That's pretty scary." And he's like, "Yeah." And he's like, "You want me to put something in there about it?" And I'm like, "Well, of course, yes." And he was joking with me and stuff because he had already picked up on that. He quizzes me to
Yeah.
see what I pick up on now. Because I always joke that I'm going to become an attorney in my next life, or I'm just going to, now that I finish one schooling, I'll go
I
get another one to be an attorney. But no, that's
wouldn't
not
be
the case.
surprised.
No, no. So, not yet. Not
Yeah.
well. I said that, but you never know. So I might just get fired up one day and just go become an attorney. If I get
Or
pissed off
open a law
enough.
firm or something
So.
to manage.
What else, Jamie? We've kind of touched upon, I think, the top, five. I'd consider pretty much the top five things in,
Hmm.
a fund. What are some of the other things you think people should be, look
Yeah. So
for? Any
let's.
other last
Uh,
minute tidbits?
I mean, I think we've hit a lot. Um, Competent and experienced manager, transparency and communication.
Yeah.
Number three is supportive economic conditions.
Yep.
Number four is upside potential or potential for split of excess
Yep.
distributions. And then
The
number five
waterfall. Yep.
was
The,
with the waterfall, right? And number five is the management fee. What is that based on?
mm-hmm.
And then we threw in a couple other little
Yeah.
tidbits. Um, I think that covers it. I mean, do you have anything else?
Uh, no, I mean, look through the documents, and like we mentioned, just because someone's going to say, "Hey, I'll give you 18% preferred return," doesn't mean that you're going to get it. So
Right.
understand, ask what is historical. Look at if it makes sense. From that perspective, if the historical returns on notes are, 20%, and somebody's giving you, a 12%, and then that doesn't include, other, all the ancillary fees that you have to, is it realistic? Somebody's running $1 million fund. That seems, I'm like kind of scratch my head. A 10, 20, $30 million fund. Yeah, maybe it makes a little more sense depending on the asset class that they're buying. But,
Yeah, I'll just
we,
kind of recap. I mean, my view on whether it's note funds or multifamily and any asset class. I think the fund manager, the operator, is definitely number one. That's who you
yeah.
really need to do your due diligence on, no
Mm-hmm.
question. I mean, there's just
Mm-hmm.
and then number two to me is I guess market conditions.
Mm-hmm.
Asset class, economic conditions. What type of assets do you want to be investing in?
Mm-hmm.
And then number three, drill down to the particular deal or
Yeah.
particular notes you might be buying. So big picture, that's how I view it.
Yeah.
One, two, and three.
I agree 100%. And my last note and bolt for this episode, then I'll let you get yours. You can't compare asset classes. You can't compare a multifamily fund to a note fund. They're completely different. The structure is different. The returns are going to be different. The length is going to be different. The risk is going to be different. It's like trying to compare a tech stock versus a, you know, Disney stock or something along those lines. I mean, they're two completely different asset classes, and what the, the length, the term, everything is very different about them. And that's one of the things that I get asked a lot is, well, on a multifamily, I can get, up to 18%. And said, yes, your money's tied up for 7 years. And it's a lot riskier because if when you go to liquidate, refinance, or something happens and rents are not stabilized, rents have gone down, or you've had issues with the property, whatever may be the case, you're of much significant higher risk of losing a significant amount of money as well. So
Yeah,
the
and
risk
if
comes
you've
with the
got a
reward.
good, yeah, absolutely. I mean, we've compared notes with rental properties and hard real estate before, and yeah, you can't compare the returns from one asset class to the other. It's an entirely different thing. Certain asset classes have uh, inherent tax advantages.
Mm-hmm.
I think one reason people, frankly, with money may invest in a note fund is diversification. I
Yeah.
mean, even though you are getting some of the upside potentially, maybe they have an investment in other asset classes, so they want to also make one in notes that helps diversify across asset classes.
Yeah.
So,
And you see a lot more investors using their self-directed IRA money with note funds.
mhm.
Which, if that's the case, review the PPM to see if the person, or ask them if they're going to leverage, because if they use leverage, it basically pretty much blows out the whole, good portion
Mm,
of the use of using a self-directed IRA. But I see a lot of people
mhm.
use that for note funds because on the multifamily, you're not getting the tax advantage anyways. So,
Mhm.
uh, because it's it's deferred, whereas in a note fund, one of the unfortunate things is it's ordinary income. That's
Right. Yeah.
that's one of the biggest hurdles I have with investors when they look to invest, if they're using their own cash, that are high net worth. They see it's ordinary income, and they don't want to use their own cash.
Yeah. I mean, that's, we did the episode on top 10 reasons to invest in notes and then a follow up on
Yeah.
reasons not to invest in notes. And I think that's one of the things, hopefully, that people appreciate
Mm-hmm.
about our approach is that we tell it
Mm-hmm.
like it is. I mean, notes are amazing. I spend
Mm-hmm.
most of my time focused on notes, but
Mm-hmm.
there's no perfect asset class.
Yeah.
Everything has pros and cons. So do your research,
Yep. So number
really.
7 slash another note and bolt is understand the tax implications of the note fund.
Absolutely. Yeah, uh,
That should be up on that
absolutely.
list.
Taxes are important.
Yep. What's your note and bolt, Mr. Bateman?
I'll be honest, I was a little unprepared on this one. So I'm just going to say, please give us a review. Um, it's a shameless plug. I can tell you, as a listener of many podcasts, I often do not leave a review. So I get it, right? It takes a little bit of a pain.
Mm-hmm.
But to the listeners out there that do appreciate the content that we're putting out, it really does help us if you can give us a review, and we hopefully that's 5 star, but if not, that's fine. But yeah, that's my note and bolt for today.
Yes. So, and you can leave that at it's not iTunes anymore. It's
Apple Podcasts,
Apple
I think.
Podcasts, and on our
Yeah.
website. I know on Seveney Investments website, if you go to the
Hmm.
podcast, if you click on subscribe, there's a link there that shows you how to leave a review. So we
Yeah.
make it as easy as possible for you. So
Exactly.
cool. Any final thoughts before we wrap up this episode?
No, I'm good. This has been good.
Cool. Well, we've already told people, leave us a review. If you're looking for more great content, listen to the podcast, come join us over on Facebook at the Notes and Bolts from Good Deeds Note Investing Podcast group. Jamie's got his Labrador Lending YouTube page. I've got my 70 Investments YouTube page. Also, Integrity Mortgage Note Fund is our
Hmm.
fund. If you go to integritynotefund.com, you
Hmm.
will also be able to check out what we're offering in our new fund that we just launched that has a preferred return with excess distributions, and the preferred return varies depending on the investment amount. So make sure to check that out. We've got that launch. We've started raising money, and we're going to start looking at our first pool of assets to acquire. So it's exciting.
Absolutely. I'm excited about it.
You don't look excited, Jamie. You look a little calm today.
We went over this yesterday. You're the excited one. I keep us grounded.
Yeah, that is true. I was talking to somebody last night about that, and they're like, you two guys, are very different. Jamie's very
Well, it's
like
funny.
calm and stuff, and
Yeah.
you're just like, you know.
Okay, so I'll give you a real quickly. A couple examples. I know we're wrapping up. I played lacrosse in college, and I would score a goal, and my coach would make fun of me because I'd go right back to the same, the starting spot, because
Mhm,
I expect that of
mhm,
myself, to be honest, and it may
yeah,
sound cocky, I don't know, but it's like, that's my minimum threshold. It's to succeed, so it doesn't, I don't need to be too celebratory. And then another one, I just got the second COVID shot, and my wife was making fun of me because I claim I was in, pain and not,
mhm,
I was hurting a little bit, but she says I had the same face the whole time
mhm,
that I have all the time. So it is what it is. But I need that energy. I feed off of
mhm,
that energy that you
mhm.
bring to the table. So I think it's a good
So,
partnership.
so I, um, I played football and baseball in high school, and then did a little bit of baseball in college. So I was when I was quarterback, my junior and senior year, was the time right around Deion Sanders was my favorite athlete,
Hmm.
and
He was
Deion
incredible.
was a little flashy.
Oh yeah,
So
still is, I think.
yes, actually he is. He used to have a show with his wife. That was pretty interesting. So I, have some very old VHS tapes of me high stepping down sidelines.
Oh my
um,
god.
but what's interesting though is I was very similar. Like I was, an exceptional basketball player too, back in the day when I was younger, and I would never celebrate. I would just, basically, because my father was like, "You're expected to do that," and stuff.
Hmm.
So, but in football is a
Yeah,
little bit different, But if
yeah.
when I scored though, basically I turn, hand the ball to the official, and just move on my way. I would never talk. I never talk smack. I kind of would,
Hmm.
maybe showboat a little bit once in a while, and so
Yeah.
forth, but not, I would never talk smack because, I'm full of the opinion that if you do, it's going to come back at you.
Right.
So I don't taunt people or anything like
No, you
that. So
talk with your actions,
yeah,
just go score again.
yeah. I mean, in reality is, especially now with business, and some people, they say, say things, but I'm just so focused on my business and like just get out of my way because I'm going. And if I offend somebody, I'm sorry. If I come
Hmm.
off as being a jerk, I'm sorry. I say it like I see it, but I'm just ultra focused because I've got a few things going on, one or two maybe, 300 notes
you
and
you
everything
left
else.
out the word you left out the word hundred, 1 or 200
Yeah.
things
So,
going
I mean,
on.
it's just like I'm just ultra focused. And, I was
Yeah.
joking with somebody last night. I made the comment. I said, "Hey, when my day on this planet comes to an end and stuff, I can honestly say I left it all, I didn't leave anything left on the table. I went
Yeah.
all out." So, and that's kind of, type of
Yeah.
person
I
I
had a
am.
roommate in college that he was a power lifter. I may have mentioned this before, but he would always say, people would say, "Oh, powerlifting is dangerous. It's bad for your knees to squat, 700, 800, 900 pounds." And he would say, "Well, would you rather rust out or wear out?" It's so
Yeah.
it's like, just get after it.
Yeah.
And yeah, you might have
Hmm.
you may make some mistakes or get injured or something, but that's much better than having regret for having
Hmm.
not tried and, put your best foot forward.
Yeah.
So
Oh, I think we can wrap up this episode of the Good Deeds No Investing podcast. As always, everyone, go out and do some good deeds. Thank you.